Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com.
Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is Tuesday, July 26, 2022. Got a big show for you. We got a big week ahead. Likely the most important week of the year so far. We have so many earnings coming out. Over 170 companies in the S&P 500 reporting earnings this week. We have the Fed. The Fed decision comes out Wednesday afternoon. We have housing numbers. All that and the fact that the major indices are hanging right above the 50-day moving average. We're going to talk about all that and more coming up right now on Making Money. Once again, this is Matt McCall. Thanks for joining me. It's Tuesday, July 26, 2022 here in South Florida. It has been hot. I will tell you though, I've never been so happy to have some rain outside right now. I didn't mind walking to get my tea this morning in the rain because it actually feels like it cooled things down. It felt good. It was like walking in a shower, but it was still hot out. I know everybody around the country and many places around the globe are complaining about heat right now. So I hope everybody's staying cool. Air conditioning's popping, but then again, prices are going up, so it costs more. So we're not gonna get into inflation today, but I hope everybody's staying cool, having a great summer so far. We're about halfway through right now or so. So everybody's having a great summer. But speaking of summer, this is the busiest week of earnings. As I mentioned in the open, over 170 of the 500 S&P 500 stocks are reporting quarterly earnings this week. That's made for market movement, if not. We'll talk about a couple of companies that came out today that are moving the market. Some big names, folks. Then we have the Fed. The Fed meets Tuesday and Wednesday, today and tomorrow. Tomorrow, midday, it will announce its decision on interest rates. Odds are right now, there's about a 70% chance, give or take, that the Fed will raise interest rates by 75 basis points. Again, 0.75%. But after the inflation number came out a couple of weeks ago, the odds of a 100 basis point rate hike, that means a full 1%, we're actually leading. That has since come down. And I believe it's going to be 75. I think going 100 may spook the market a little too much for the Fed. To me, though, you might as well just do it because eventually you're going to keep doing. You're probably, the next meeting, there's not one in August, but there's one in September. The odds right now for 50 basis points. So you add it together, it's 125 between now and then. It might even be 150 if inflation continues to stay high. So if that's the case, just do 100 now. Kind of get at it. Let the market take its lumps and move on. But I don't think that happens. I think we'll see 75 basis points. I think that's kind of baked into the cake right now. And it's obviously going to be a driver. The comments from Chairman Powell will be a driver, along with some of the economic numbers that have been coming out. We've had some housing numbers come out recently, a few more this week, and showing a housing slowdown, which isn't a big surprise considering interest rates keep going up, which drives mortgage rates up, which of course makes houses more expensive. So none of that really is too surprising for me. So speaking of which, let's take a look at the market here real quick. Let's take a look at the S&P 500, where we are this morning. And as I mentioned, we're down this morning on some earnings news. Down about 0.6% on the S&P 500, and kind of a sloppy looking chart, but this all makes sense. This white line here, I've talked about in the past, this is the downtrend line. As you can see, it continues to go up through that and keeps failing, making lower highs and lower lows. However, last week we blew through that line. We've been holding above it now for about 4 trading days. So if we hold above that level, that's extremely bullish in both the mid and long term. The red line here, tough to see, but we're holding above that. That's the 50-day moving average, which has also been a resistance level for the S&P 500. Now, if we click over to some of the more aggressive technology stocks in the NASDAQ 100, see a very similar chart. We can see here the white line is the downtrend line. We broke through that about 2 weeks ago. And then the red line is a 50-day moving average we're holding above. So when it comes to both indices, we are holding above some very important former resistance lines that now turn to support. So if we can hold that, that's actually really, really positive going forward from here for the overall market itself. The reason the market's down this morning is the largest retailer here in the country came out with some pretty poor numbers. And they blamed it on supply chain issues. And that's Walmart, symbol WMT. We'll take a look at a stock here in a moment. But Walmart came out, and when you have the largest retailer, brick and mortar retailer here in the country, come out with some ugly numbers, you'll see here this chart is pretty ugly. It's going to drag down the market. And as you can see here in May, it got hit. It had some really bad news in May. It fell from 150 down to 118. Then was working its way back up. And again, today, falling now down about 8.5%, about 30 minutes into the trading session. So, of course, that is obviously weighing on the entire retail sector. And here's the XRT, which is the S&P Retail ETF, down about 3.8% today, still in that downtrend, continually to making lower highs and lower lows. So it's not surprising when such a large influencer on the markets, such as Walmart, comes out with disappointing numbers, that it weighs on all types of companies related to Walmart, whether it be suppliers of them, whether it be its competitors, whether it be logistics companies, anything related to the consumer, taking a hit today. So it does make sense. One of the companies that used to be a big name a century or so ago is 3M, symbol MMM. And as you can see here in the chart, it gapped up on earnings. But the big news here we're seeing with 3M is they announced they're going to spin off a healthcare business. And 3M is a bit of a conglomerate. It's, it's kind of like a General Electric, where it's made up of a bunch of different areas, whether it be everything from Post-its and Scotch tape to healthcare, to wound care, to electrical connectors, so a little bit of everything. So they feel the best thing is to spin off this multi-billion-dollar business that is the healthcare business. And as I just showed you in a chart here, 3M moving up on that news. So that's moving the market here today. Obviously, Walmart's having a much bigger effect than 3M is having on the market. And speaking of the Fed, I mentioned 75 basis points. Now, let's take a look real quick at where the yield in a 10-year is right now. And as you can see, yields have been going up since the Fed kind of started even just talking about rates going up, and inflation started going up. Going back basically 1 year ago in July, rates were down about 1.15%. We went up to about 3.45%. But in the last 6 weeks or so, you can see we've really come down, and there's big support at 2.7%. This line right here, if we break below that, you're really kind of, it's rolling over. And I've been saying this for quite some time, that this run up here coinciding with a sell-off in the stock market at the same time, that was an indication to me that we priced in the Fed coming up, because obviously the Fed is going to raise rates tomorrow. Obviously, the Fed is going to continue to raise rates for the next few meetings. And at the same time, we know that, yet the yield on a 10-year has been coming down. So that tells me two things. One, that a lot of people had anticipated that ahead of time. Makes sense. The other thing is, for interest rates to fall on a bond, that means there's buying of the bond. So there's an inverse relationship of the bond price and the yield. So it means people are buying into 10-year treasuries, which means that people are still concerned about the overall economy, because they're locking up a 10-year for 2.7% right now versus going into stocks, equities, and looking for growth, obviously more than 2.7% annual return. Right, it's tax-free, but still. So something we want to keep an eye on tomorrow after the Fed comes out. If we break below 2.7, maybe that's signaling the Fed will not be as aggressive towards the end of the year, which would be very good for stocks. So there's a lot of moving parts going on right now. Watching the yield on a 10-year at 2.7% will be one of them. I mentioned earnings season. We are in the midst of earnings season right now. And before earnings season began, the estimates for revenue to increase year over year, second quarter over second quarter last year, about 10%. Earnings per share to increase about 5.6% year over year. But if you take out the energy sector, which has been strong, obviously, with oil hanging around $100 levels still, sales are only expected to be up 6.7% versus 10%, and earnings per share are actually expected to fall 2.4% versus an increase of 5.6%. So you remove energy. Though, I understand why we talk about that, why I'm talking about it. But what happens a lot of times is it's any quarter I could say, well, remove tech if tech's having a good quarter, remove healthcare because they're having a good quarter. The thing is, it's a basket of several sectors, 10 sectors, and certain drivers will be driving it up, certain drivers will be driving it down. If you would have removed energy the last couple of years, the numbers would have been even better because energy stocks were getting killed. They negative top and bottom line. So let's take it for what it's worth and not look quarter to quarter either, look more over the year. But overall, earnings aren't great. They're not bad. It's going to be more individual to each specific company. And that's why we're going to see companies such as Walmart, such as 3M, moving on their individual numbers. So today's show, I want to talk about the kind of the gist of it is the future of farming. And the reason I really want to bring this up is, we're having this major heat wave I spoke about when I started the show. I mean, it's everywhere you turn on TV, and it's hot. This is my first summer in South Florida, and for those of you who live here a long time, probably are laughing at me, but it's hot. It really is. I was running midday for a couple of weeks around 3 o'clock. We're in the middle of the heat, trying to get a good sweat on. Then I realized it probably wasn't the safest thing in the world, so I stopped doing that because you could easily have some type of heat exhaustion or heat stroke or something. It's that damn hot. But in Baltimore last week, I'll be a Northeast up in Philly this weekend, and I tell you, you're up there and it's just as hot. So I feel for everybody out there. But as far as agriculture is concerned and farming and crops, we're already dealing with a lot of droughts in the Midwest, in Oklahoma, Kansas, Texas. Now you're adding this heat on top of it, and it's becoming quite an issue, especially in harvesting season that we're having right now. And on top of that, as we know, Ukraine is the breadbasket of Europe. You had Odessa, which is a major port to export the grains. They had this weekend a bit of a not ceasefire, but Russia was going to let them export the grains. Well, that lasted about 12 hours till Russia went and bombed a port in Odessa that was exporting grains. Hopefully, they can get back out there because there's a lot of very poor third world countries that are relying on that food, and we do not want to see people go hungry. There's already too many people going hungry right now. So, give you a couple of numbers because obviously I'm a stats guy. By 2050, we're going to need to produce 70% more food just because of the growth of population in the world, on top of the fact the growing middle class, more people coming out of poverty are able to eat more and better food, which creates more demand for food. Unfortunately, there's about 800 million people right now worldwide that suffer from hunger, which is just sad. One person's too much. The amount of food, I go out to eat quite a bit, and the plate size is so big. Like, you don't need to have all. You waste so much damn food. And you think about farming, there hasn't been that much innovation in the last couple of decades. Sure, we're starting to see it come in. We're going to talk about what I call ag tech here in a minute with artificial intelligence and other things coming into it. But we haven't seen major innovation in farming, and we have to. California is going through one of the worst droughts it's seen in decades, if not over a century. You have Lake Mead, the pictures. I mean, just Google Lake Mead. You can see the pictures of Lake Mead where it was years ago to where it is now. It's almost unrecognizable how low the levels are. I mean, they're finding cars and boats and things that have been there for literally decades because they're so low now. You're starting to find all this crazy stuff. And that's sad because a lot of people rely on Lake Mead for drinking water. Obviously, it supplies water to a lot of Southwest states. So that is a major issue on top of everything else that's going on. And you look at farming here in the States, and the average US farmer is above 60 years old. And there's not a lot of younger people out there rushing to become a farmer. I mean social media, other things, like, it's a tough job. Not only is it tough manual labor, you need to get employees to do it. It's not easy to do that. That's why a lot of the employees are illegal immigrants. You don't know from year to year what your crop is going to be due to, again, outliers, weather is a huge one. What's going to happen? So it's not this luxurious job that a lot of people are running to have, and it makes complete sense to me. But technology is at the forefront, and technology, in my opinion, will solve this. Think about it. Sensors. We'll talk about that. Automation, robotics, artificial intelligence, Internet of Things, connectivity of stuff, genomics to really help create seeds that can withstand droughts and withstand higher heat. And I'm not saying, these genetically modified stuff, GMOs, You could use genomics and not do it that way. It's a little bit different. I know it sounds confusing because the word genomics is in there, but it's not the same. It's a bit different. Some of the things that may come out of this, more hydroponics, that's kind of growing inside with water. Vertical farming. There's been a couple companies that have gone public lately that use vertical farming, indoor farming. Drones that keep an eye on the crops and the livestock that are out there. Automated farming devices. I mentioned robotics. And plant-based foods, which was really big. And I don't know if it's a fad or a trend. Probably a trend. I think it's a fad. I think anytime you look at something, a box, it should have less ingredients. I'm a whole food type guy. If I'm eating a steak, I know it's a grass-fed steak. That's all you need to know. If I'm eating a fake steak or a fake burger and there's 70 ingredients and I can't pronounce any of them, that concerns me because I don't know what the hell it even is. So let's take a look at some investments here that could take advantage of the future of farming and the future of agriculture, ag tech, whatever we want to call it. And we'll start with two ETFs. And I think it's important to take a look at these because they give you a bit of an idea of what's going on in the overall sector. So this is the Van Eck Future of Food ETF. The symbol's YUMY. I love these ETFs. They come up with great symbols. YUMY. And largest holdings are a lot of fertilizer companies and agriculture companies, Corteva, Ingridion, App Harvest, which is a company that does some vertical farming. Deere is in there, obviously the world's largest machinery for farming and agriculture, which I'll talk about that stock a little bit more in detail. But you can see in the chart, it's a newer ETF, came out early December of last year, just been in a complete downtrend. So take it for what it's worth. And the other one that's in this area is KROP, symbol KROP. It went public last July. Again, very similar chart, lower highs, lower lows. This is the Global X Ag Tech and Food Innovation ETF. Some similar holdings, but a little different. Its largest holding is Oatly, which is the oat milk company. Corteva is number 2. It's number 1 in the other one. Beyond Meat, which is the plant-based food company. Nutrien, Titan Machinery, which makes some machinery similar to Deere for agriculture. So a little bit different makeup, but at the end of the day, they're kind of going after the same thing. And I'm not a fan of ETFs anymore. When I first started this business years ago, I was a big fan of ETFs because it was a great way for the retail investor to gain access to specific trends. And back then, it cost anywhere from $10 to $100 to buy a stock. And then you have to sell it on the other side. So you're buying a small amount, you're trying to create your own basket. It's going to cost you a lot of money, and you have to make a few percentage points just to get back to even. Now, nobody charges to buy or sell stocks anymore, so you can create your own basket, whether it be 3 stocks, 5 stocks, or 10 stocks. So if you're putting 1,000 into the future of farming and ag tech, you would put 5 stocks, you put 200 in each. If it's 10,000, it's 2,000 each. You can do the math. You just split it by how many ever, and you create your own ETF. Keep in mind, you may not have to pay to buy the ETF, but the ETF still charges an expense ratio. And that expense ratio, you don't notice it come out, but it does lower your return. So for example, let's take a look at KROP. I don't know what it is off the top of my head, but KROP, KROP, is an expense ratio of 0.5%. So right off the bat, you need to make at least 0.5%. And you say, Matt, well, 0.5%, big deal. But it does make a difference. And the Van Eck one, for example, is 0.69%, 69 basis points. So it does eat at your return over time. So keep that in mind. So let's take a look at a couple individual stocks that I think could be used to build your basket of the future of agriculture, future of food, ag tech, whatever the hell you want to call it. The first one we'll take a look at is a big company. And this is about a $97 billion company. This is Deere, symbol DE. It's pulling back here from a high that we hit in April with a lot of stocks in the market. It's the world leader by far in the manufacture of agricultural equipment. It's got over 3,700 locations globally where they sell their machinery. And take a look at the numbers here. In 2021, so last year did about 43.5 billion sales. This year looking for 47.2 billion. And then by 2024, 51.2 billion. So not huge growth, but it's also a big company. So that leaves us with a forward price of sales about 1.9, which isn't bad again for a large company like this. Earnings per share last year, $18.99 a share. This year looking for $23.15, and then up to nearly $27 in 2024. But that gives us a forward PE ratio based on next 12 months, about 12.4, which is well below the market average. So I like Deere. I think this is a company that is at the forefront of a lot. I talked about automation. I talked about artificial intelligence, sensors. We talked about this 2 years ago, 2.5 years ago, I guess it is now, at CES, the big technology conference in Vegas, every January. I was able to go sit in a huge Deere tractor, and boy, it's just beautiful. It's like sitting in like a Rolls Royce of um, tractors. I mean, this thing was enormous. You had to climb up this ladder to get in it. But what's amazing is the sensors and the artificial intelligence. This one was driven by somebody, but the sensors could tell what were weeds, what were crops, what chemical it should be spraying or whatever it should be doing. Eventually, you'll have that will be all be automated. It'd be an autonomous vehicle, and they kind of have those already. Not that size, I don't believe, but you'll start seeing this, and they're very large expenses for farmers to do upfront. That being said, Deere has such brand loyalty in that business, which will I think will never go away. And the break even cost savings over years, if you're a farmer for years, makes sense. Takes away your time sitting in there. It's going to be more accurate than somebody else driving it, and to pay somebody to do it. So I think you will see Deere become very much a technology company during the roaring 2020s. The next one, we're going to take a complete shift here from a $97 billion company to a $400 million company. And this is App Harvest, symbol APPH. And it's a company that went public. I could pull out here and show you back in 2020. It was a SPAC at $10 a share, ramped to 42. It was a high flyer, all the way back down to $3.83 here today. And it does a controlled environment indoor farming, does some vertical farming, does tomatoes and some other fruits and vegetables. Tomatoes is kind of their big thing. So sales wise, I just mentioned it was a $400 million company. Sales wise, it did 9 million last year, looking for 27 million this year, so 3x. By 2023, looking for 102 million, and by 2024, $245 million. So from 9 to 245 in 3 years. If this company is able to hit those numbers, this goes from 3 to probably 20. That being said, if it doesn't hit the numbers, it's clearly the market hates it right here, because you look at it and it's losing money, and it doesn't have a path to profitability right now, which is a big red asterisk for me. I don't care if you're making money now, but you need to have a path. And I'm sure they'll break even at some point if they hit these numbers in the mid roaring 2020s, but there's nothing in the next couple of years that tells me they're going to start making money on an annual basis. That being said, with revenue expected to grow about 66% annually, huge numbers, and bottom line earnings are improving. So they're actually improving by about 52% annually. So you're getting there. And you put it at, price to sales ratio right now. It's about 4 times price to sales. But if you look out again to 2024, you're at less than 2 times sales. Again, if you believe they'll hit these numbers, this stock is a complete bargain down here. However, the market's been punishing companies that don't make money. So when that ends, I don't know. I think it will end. I just don't know when that is. So back to a little bit bigger of a company, and this is a Nutrien, symbol NTR. Take a look here, and this is a pretty nice looking chart. Pulling back from a high in April, like a lot of these stocks, because a lot of the agricultural chemical stocks and the ags themselves hit highs there, pulling back. So Nutrien's a $44 billion company. They do crop nutrients, everything from potash to nitrogen. So fertilizers, basically, for farmers, something farmers rely on. They also do seeds and crop protection. They're in over 200 retail locations. And their sales last year, 27.7 billion. This year, looking for 40 billion. So big increase. But then dipping next year to 35 billion. So it's kind of a little bit of a wonky look. And same thing with earnings. You have earnings last year of $6.23 a share. This year, looking for earnings of $17.15 a share. So obviously, huge jump. But then down to $14.09 next year. But even in that pullback next year, say it hits $14 a share next year, you're still looking at a PE ratio of about 6, based on where it's at right now, at about $82 a share, PE ratio of 6, price of sales about 1.2. So it's still not close to being overvalued. It's extremely undervalued, but the choppy numbers can be a concern. I like to see that's going straight up. But again, this is definitely a leader, and as crop demand increases and the yield of the crops falls due to weather and other outside factors, more of potash, nitrogen, fertilizers, etc. are needed. Better seeds are needed. So companies like this will be in need. So the last one I'm going to talk about, the fourth one here, going small again. And this is Lindsay Corporation, symbols LNN. This company I've followed for a while. It's about a $1.5 billion company. I'm going to show you a long-term chart here. I mean, this has been a big winner over the years. You can see it's pulling back. Nice support around this level down here, really. Again, a very long-term chart, but we'll zoom back in. And Lindsay Corporation, as I mentioned, $1.5 billion company. It's known for its irrigation systems, water management. They're also using satellites and software to minimize use of water because, as I mentioned, we're in droughts and all kinds of other things. But they use some AI, some artificial intelligence in what they're doing. And they're definitely a cutting edge company when it comes to water management, which is one of the biggest issues when it comes to farming and agriculture right now. Last year, they have sales 567 million. This year, looking for a nice bump to 760 million. And then a little bit bump next year, but then 2024, 760 again. So again, you're kind of seeing this bump up with the demand we're seeing right now. I think it will, these numbers are low. Last year it made $3.88 a share, looking for 570 this year, up to 840 in 2024. So even as revenue is supposed to be the same this year as it is in 2024, earnings are expected to jump from 570 a share to 840 a share. That means margins are increasing. That is a very important metric when it looks at especially smaller companies. Really like what they're doing. Really like this company, and if they could hit these numbers again, it's trading at PE ratio right now of 22, price to sales about 1.9. But based on those continued earnings growth, this is a company you definitely want to keep an eye on. So, this is an area that a lot of people overlook because we just assume the food's going to be on the table. We assume that we go to grocery stores, it's going to be there. But we're starting to take notice of a little bit more because of inflation, because food costs more. I went out for a glass of wine last night, and it's usually in Del Rey, you go to happy hour between 5 and 7 because everything's half off. I went a little after 7 because I was doing some work just for one quick glass of wine to relax before I went to bed. And I couldn't imagine, it was so expensive. And it was okay wine. It wasn't fantastic, but it was good. And just looking at the food prices, they really are going through the roof. So I'm feeling it too, folks. I really am. So when it comes to that, there's ways to make money off that. And I really believe investing in the future of ag tech, future of farming is a great way to diversify a portfolio because many people out there right now don't have exposure to this. So you can build your own little basket. And my team and I can continue to do more work on this. And we might actually put a portfolio out in the next few months if we can come up with good stocks for our subscribers. So again, thank you so much. And the Fed will come out tomorrow, just like I hope the sun comes out at some point today. The sun will come out tomorrow, but we know the Fed's coming tomorrow. And don't forget, if you don't already get my daily update, sign up for it. It's free. Click the link. You get to go right to that. And we will do a special update on the Fed tomorrow. My thoughts, as soon as it comes out right after the bell, you'll get that update. So again, thank you so much for the support. Thank you so much for following. Don't forget to like, subscribe to the video, share it with your friends, comment if you have them. Good ones, but I'll take the bad ones too. I like reading them both. But again, thank you so much for watching. I hope everybody has a wonderful day. Stay cool out there, folks. I'm sure there's a break in the weather coming soon. But we'll be back Thursday with a great interview coming your way. Until then, be well, be safe. I'm Matt McCall, and this was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.